GetCrack. Wake up, motherfucker.
Number of concerning items, including the videos that you've seen out in public. But at that point that is viewed as the likely source of ignition, we're not seeing the typical signs of ignition. We're not seeing the arc marks. We're not seeing the molten metal or the missing metal. And so we are eager to continue to look further. A key next step will be to remove the transmission line. It's an idle, de-energized line. We want to remove that from the tower to inspect that. It may still take us a few more weeks to do that, Dale, because we are in the middle of negotiating a protocol for how we do that safely and appropriately in concert with a number of the plaintiffs' attorneys and other stakeholders.
So then broaden it out. I'm assuming that if you take a look at that, you're going to have to take a look at all your idle transmission lines and make sure there's no risk going forward. What kind of labor, time intensity, and also maybe CapEx will be involved in that?
Well, Alex, if it ends up being that this idle line was involved, it will not have been through a typical ignition mechanism. And it was at the energized line. It sits next to energized lines. There was no fault on those energized lines. There was a fault somewhere between 5 and 12 miles away on a different set of transmission lines. And so the idea being explored is that somehow that fault led to an increase in current, which then led to induction. If we find that that was indeed the mechanism, A, we want to learn so we can make our system safer, and B, we want to share that with the industry, because I think the entire industry will be safer coming out of that. I don't have an estimate for you yet in terms of what that would mean financially, because we don't even know if this is what happened. But at a minimum, it would entail, thinking about how we do our inspections, how we do our grounding, how we, continue to maintain those idle lines. And again, I want to point out, these are not abandoned lines. They're idle lines that we inspect annually and maintain.
I am curious, Pedro. So as we move forward and we get through the investigation and those inspections and actually start to get down to the rebuilding and compensation, where does that money come from? There's been a lot of talk here about replenishing the wildfire fund and potentially replenishing some of those funds with money out of, effectively, your own shareholders' pockets.
Yeah. So I want to remind folks that in California, we have legislation that was led by Governor Newsom and the legislature in 2019 that frankly is the model for the country around how to work through wildfire mitigation. It does three things. It set wildfire mitigation plans that are overseen by the regulators that define the expectations for utilities in keeping the system safe, and therefore they keep our community safe. Second thing it did was that it recognized that the risk will never be zero. As hard as we work as utilities, as hard as the state works on firefighting, in spite of everybody's efforts, we have extreme weather. We had 100-mile-an-hour hurricane force winds that prevented firefighters from flying their aircraft during this event. Because the risk will never be zero, the law created a wildfire insurance fund that has a capacity of around $21 billion. And so, Romaine, that's where the funds would come from if this fire is determined to have been linked to Edison equipment. The third thing, by the way, that the law did was that it created the right balance between keeping our shareholders, our company, accountable, right, while at the same time maintaining the financial health of our utility companies so that we can serve our customers and serve the state. And so just as a reminder, if the company is found to have been linked to the fire, it is presumed to have acted prudently, reasonably, because we have a safety certificate in hand.
Yeah.
If at the end of the process somebody creates serious doubt about that, we will then have to show to the Public Utilities Commission why we believe we were prudent. If we're found to have been imprudent, there is a cap on the exposure to shareholders. It's 20% of our T&D equity rate base. Today, that would be about $4 billion.
Right.
In the future, that might be a bit larger as our rate base grows. So let's say it's $5.5 billion. That's if we're found fully imprudent. The commission might decide that we were partially prudent and assess a lower disallowance.
Yeah.
That's still much lower than our market cap of around $20 billion today. So it's a good balance between enough pain for the shareholder to keep us accountable while preserving the financial health of the utility.
And as you sort of move beyond that, there are some longer term issues that you have to address as well. I mean, there are going to be upgrades one way.
Concerning I decide that we were partially prudent and assess a lower disallowance.
Yeah.
That's still much lower than our market cap of around $20 billion today. So it's a good balance between enough pain for the shareholder to keep us accountable while preserving the financial health of the utility.
And as you sort of move beyond that, there are some longer term issues that you have to address as well. I mean, there are going to be upgrades one way or the other, whether it's directly related to what happened with the wildfires or really just your own long-term planning. In that process, I am curious about the cost to do that, particularly given some of the shortages we've seen with transformers and some of the other components, and particularly against the backdrop now of what potentially are going to be new tariffs that could further exacerbate that shortage.
Yeah, absolutely. And we're looking at all of that. I do not have an estimate for you today of what rebuilding these areas will entail. Our team is working on that. Team moved very quickly to repower everybody who could receive power. We're now looking at how we rebuild, particularly the most impacted areas. We expect undergrounding will be a larger part of the solution because that's our standard for new developments today. And sadly, areas like Altadena will look a lot like a new development, given that the horrible devastation there. You're right, to the extent that tariffs come into play. We've certainly seen President Trump's policy on that still evolving, but that could put a lot of pressure on the underlying materials.
Do you feel confident you pass through there to your customers? Would you be allowed?
Well, that would be a cost of service, appropriate cost of service that would be passed through to customers. But importantly here, we've done a lot of work over the last decade to mitigate cost increases. If you look over the last 30 years, SCE's rates have increased at around the level of inflation. We went well beyond that over the last 5 years, driven by power market costs, as well as wildfire mitigation costs and the cost of a number of policies in the state. However, we have provided disclosures that between 24 and 2028, even if SCE gets its full request in its general rate case and its full request in a number of other proceedings, we see rate increases at SCE going back to growing at around the level of local inflation, around a 2.6% CAGR, annual increase, compounded annual increase to 2028. And while the devastation in Altadena and in Malibu was significant in the context of our large capital program, which will be around $8 billion a year, I don't expect that that alone would create a significant delta over that 2.6%.
Sinking today as tariff uncertainty and more soft data weighed on investors, including a report from Challenger Gray and Christmas showing the highest level of layoffs since July 2020. Joining us now is Claudia Sahm, chief economist at New Century Advisors, former economist at the Federal Reserve. Claudia, welcome. So 2/3 of the reported layoffs in this were in the private sector. We've got DOGE that's been working on more public sector layoffs. At what point do we know if this is creating an environment where not only are jobs being lost, but they're harder to get?
Right. Well, it's a very disconcerting report coming out of Challenger. I think we should think about it. That data can be very good at getting the direction right? So we're getting information, layoffs, both private sector and in the federal government are on the rise. Maybe that number, that may be, a little, it can be kind of noisy and it may not show up fully in the official statistics, but it is a warning flag about where the direction of layoffs. And we've known for some time that we've had this very divided labor market in that layoffs have been near historic lows for, years now, right? And yet hiring rates have not been as high as we would have liked. So we've had this risk going for a while that if layoffs were to pick up, we are in an environment where it does not appear that hiring is happening as rapidly. So unfortunately, there are some signs that this is going from a risk to being the environment that we're in, and that could be a real problem for the labor market as a whole.
So, Claudia, how much of this is government related? Do we know yet? There's a lot of talk about, DOGE cuts and DOGE impact, and that's going to ripple out from Washington. On the flip side of that, there's also a lot of misreporting out there about job cuts coming to fruition in certain agencies in the federal government that hasn't actually happened.
Yeah, the amount of uncertainty that DOGE has
that hasn't actually happened.
Yeah, the amount of uncertainty that DOGE has created with its move fast and break things process has really, it makes it hard to even get a sense of what layoffs have happened at this point. And then on top of that, you have legal cases that are putting in question whether some of those probationary workers that were laid off, whether they could have been laid off. So we're going to see probably the numbers around the federal government layoffs fluctuate a lot of headlines, potentially misreporting. It's going to take time for this to show up in our official government statistics. We are not on Friday when we get the employment report for February. It's going to come, the time frame for it, the week of the 12th. This is before a lot of the big layoffs started with the probationary workers. So we really have a fragmented picture of what's happening in terms of federal government layoffs. And then there's a big question in the spillover, the canceling of contracts that would go into, hospitals, nonprofits, state and local governments. That's another big question. And frankly, that's a much bigger pool of workers that could be put at risk from the DOGE actions.
And what does history tell us about the influence of
what's happening in terms of federal government layoffs? And then there's a big question in the spillover, the canceling of contracts that would go into, hospitals, nonprofits, state and local governments. That's another big question. And frankly, that's a much bigger pool of workers that could be put at risk from the DOGE actions.
And what does history tell us about the influence of federal budget and job cuts on the private sector, including, as you just referenced, contractors and businesses that are closely connected to the federal government and geographic areas where the federal government is a big employer?
Right. So unfortunately, history may not be a great guide here. Like the federal government employment, it's less than 2% of overall employment. Even if you take the federal contractors, people who are employed on federal grants, that, you're still well under 10% of the labor force. So we're talking about a small group. And yet the thing that DOGE has done, because they're moving so quickly with these layoffs, is they're really concentrating at a moment in time the amount of people who are then out looking for new work. There have been times President Clinton was also decades ago put in place a long period of reducing the federal workforce. It happened over multiple years. Right now, what DOGE is doing is trying to really front load that, and it puts so much pressure on the private sector to be able to absorb that work. If DOGE would slow things down, actually, the disruptions from this probably would be much more focused on the government sector. And you can have, but that's, a choice they're making.
Yo, what's up? Sorry for that. I think StreamYard's still goofing up and stuff and pausing these videos and sucking up all the memory. So, yeah, we're gonna have to suffer through another week or two of this StreamYard's update process. I don't know. Portia knows more. I have no clue, but I did notice things working weird already halfway through the week. So sorry, guys. You must make do. We must make do with what we have. So overall, the first video was about EIX. So the Edison International. So that's SoCal, Southern California's utility. They had the wildfire, if you remember. And I'm just going to go over stuff briefly. Okay, right here with that, because I see some opportunities right now. Let's see. Hopefully everything goes well. I'm going to have to get a new laptop now. I can't just hold it off anymore if StreamYard is going to keep doing this stuff. But if I get a high-powered laptop, oh my God, I can't put it on my lap anymore. It's going to be really hot. All right. Let's go. EIX. Okay. There was some news this week on EIX. I think some counties in Southern California have started their lawsuits. They submitted lawsuits, and it will take a long while before investigation completes to show whether Edison is guilty of starting some of those fires or not. But in the meanwhile, they already started the lawsuit process already, so you're going to have to be guilty until proven innocent in this case. However, if we look at the stock, it's already been treated as that. The prices have already moved down precipitously. So around here is when I started buying, right? And then when it went lower, I started buying some more. Now that it's trying to climb back up, back to where I first initially bought it at around 56, it's starting to look a lot better, but it's still risky, you know? If at any point in the investigation, which will take a year, they find out like, yep, okay, this thing did happen. And if you look at that first video again, it was essentially, he was saying that even though that power line was turned off, a nearby power line that was on could theoretically induce it to have current flowing. So I know you guys are not electrical engineers, but essentially that's an induction process. Or you could take, like, maybe in some of you guys have taken high school physics where they actually went over that topic. Probably not, but maybe you have. But essentially it's kind of like how electric motors work, right? You energize like a piece of iron and then it starts like rotating. Now, if you consider like a coil, it can magnetize that piece of metal. So you can think of it as also if you have two parallel lines, okay? One of them has current flowing through it still. The other one's turned off, but for some reason, it can generate enough like mutual inductance that it could spark, even though it was actually turned off. So that's interesting. So he was saying like, yeah, we never had encountered any situation of that nature before, and it is theoretically possible. So we'll see. That's a little danger there, but for now, you know, I'm willing to take a shot and take it. But there are better things you can do. Right here, PCG, Pacific Gas and Electric, so that's from Northern California. It went down in sympathy, but Northern California is very different from Southern California right now. So it doesn't have any lawsuit pending, but because it's in California, I think the market just decided like, well, I don't want to own any utility company in California if this is always going to happen, right? So they just killed this one off too. So might be a better bet. So I initially got it around 16 here, bought some more at 15 there. Now it's climbing back up to 16. Could be good. Okay, so I think utility stocks can be a good play overall, especially if the AI story kind of continues. It's definitely dying out in certain parts with NVIDIA, but for the utility side, there's still some room. You know, you still need a lot of power consumption. So that growth might still be available for another year. So this stock, it could be good for 1 year ahead. And the other one was Hawaiian Electric. Okay. This thing had an upgrade. It got upgraded by two agencies. One agency, one analyst. So they upgraded on Friday. This thing had a nice pop above 11. Now, I got in, like, started adding around here, like 8-ish in the 8 areas. And then when it got up to here, I added some more. Now we're up here. So if you've been following this with me, it may be time to add some more. This could be ready to pop back up to 15 and 17 in a month or two. So watch this. So even if the market is going down, utility stocks like this, they may go down, right? But not in the same magnitude, right, as a Nvidia or Facebook or Google. That might go down even harder. So this stuff, watch it. Watch these stocks. Keep them on your watch list. If it's a good time to add, if you see opportunities, please do. They can work out really well. Okay. Let's see what else we got. Oh, okay. Let's go over MSTR. So on Friday, yeah, I didn't show up because like there was nothing really to do. Sadly, nothing really to do because we got here on Thursday, got close to the 320 level on MSTR micro strategies, renamed to strategy. So, and on Friday, no, it tried to, it was nice because you got the effect from the QQQ. Okay, so first off, we had our payrolls report. You got that, it's pushed it down. Then Jerome Powell started talking, and he was like, well, I'm still pretty confident on the economy, even though I'm going to keep interest rates steady. So it recovered a bit. But then, later in the afternoon, it's like, well, nobody wanted to hold this thing over Friday because the crypto summit, there was sell the news type of event because Bitcoin itself already went down from Thursday and never recovered early morning on Friday. So nobody wanted to touch it up here above 89,000, right? So we're back at 86,000 on Bitcoin. Now, whether or not it's going to go back up to 96,000, yeah, you're going to have to see. We're going to have to wait and see if it's still possible. But it looks like maybe trading MSTR is kind of dead. I was really hoping this would follow the NASDAQ more than the Bitcoin itself and actually try to go up to 324 into the end of the day. And then maybe next week, it'll just start going over it, regardless of what Bitcoin did, because I think the NASDAQ itself is close to forming a bottom, right? So as we can see, like here, we have a good trend. So this is the hourly chart on the QQQ. This is a good trend down. All right. This started during around Nvidia and Walmart and all these earnings started coming down and they start pushing everything, right? Pushing the whole market over. Because when we got to this top at 535 on QQQ, you can see like it starts slowing, and then you have these big red candles right after certain earnings, right? Nvidia, Walmart, and from there it just fell apart very strongly because this is a very good trend down. It's very clean. You don't see anybody buying up the stocks to push this the next day. You see it's consistently goes down, touches that 18 moving average, touches again that 18 moving average. And then here it looked like it's just trying to keep a bottom this week, right? And it got over the 18, closed over the 18, almost got to that 40 moving average, the yellow line there. But then it just gapped down again. I think it just happened overnight. I'm not sure what happened over in the European markets, but they just started puking like crazy. It's probably they just didn't want to hold anything on Thursday, and then they just completely went even worse into Friday. But then we're back at the 18. Again, we're back at the 18. So on Monday, this is what you want to see. You want to see if this thing will try to retest this low. Okay, get your cash ready. If it does and violently goes back up again, then I think we're getting closer and closer to an actual bottom because this 482 level on the QQQ is definitely important. All right, definitely important. This is all the way back at the same prices before elections. Okay, this is very significant. So this is as if Trump never got elected. We're back to where we were in Halloween, pre-Halloween. And I think it's going to struggle here to push even lower. We're already too pessimistic now. There's going to be a snapback. And once you see that snapback, it's going to go very hard up, because in a bear market, you'll have something called a bear market rally. And what that means is when the volatility is very high, this thing can shoot up like 2, 3, 4, 5% in 1 to 2 days very quickly. You could trade it very fast. And then after that, you got to switch. You got to get out and prepare to short. Okay, because once it's complete that move, it's time to short again and go down. All right, if you're in the shorting mood. Okay, so I'm gonna go to look at the weekly, and you can see right here, you see the ADX red line here, that DI line. The ADX is still low, but the red line is starting to pop up, and you can see the moving averages here starting to roll over. So if you do follow Joe Rabel's strategies, then this means bad news. If you look at these 3 red candles and compare them to these 3 red candles, they're not exactly the same, because when we got up to this top back in July, it was a stronger trend. But if you see here, we were going sideways before we start falling apart. So I don't expect a big bounce and then we just continue on our way up. Bounce, so big bounce, go back, and then go back up. No, I think here we have to be prepared for the eventuality where big move down, pop back up, but deeper move down here to 426. Okay, so that's what I'm expecting. So I'll draw that here like this. So once we did this, we already did that. So now expect a big move up, but then that means the next one's going to be a lot lower. Okay, so something like that. All right, based on what we see right now with what's given to us. Okay, so let me show like the SPY, and it's similar picture. So there's not much difference with the SPY. You're going to see the same thing, similar way it's moving. You look at the hourly, same thing. You got this nice moving average down here where it's moving down. And as you can see, in this case, if you look at the weekly candle, it's a lot larger. So compared to the QQQ, you see this weekly candle, this last one, it's larger than this red candle, this red candle, this red candle, this red candle, and pretty much comparable in size to this one. So this is, but the problem is this one is happening where we hit this 40-week moving average going up compared to this one, which hit the 18. We are a lot in a weaker position now. We've destroyed a lot of the momentum by doing this instead of staying above the purple line. And this one's going to roll over. That's for sure. This is going to roll over hard. And this will probably, like, if you listen to Joe Rabel's video, he basically said, like, yeah, we haven't had this happen since around here. You see this? And this one was kind of a light rollover, right? You got a light rollover, and we continued on our way up. This time, though, I think let's look at the volume. Yeah, comparable volume here. But this one at least just touched the 18. This one, like I said, is touching the 40. So be aware, definitely be aware and be prepared for lower prices coming around 1 month's time. I think later, by, if not in 2 weeks or 1 week even. So this week, by the end of it, we will have another budget crisis. I think the Democrats really don't want to work with the Republicans, so they might intentionally cause a drawdown. I mean, not drawdown, like a showdown, right, in the Congress over the weekend. So next weekend is going to be a madhouse. And then by Monday, you probably could see, like, if they don't cut a deal, you could probably see like a big red day in the following Monday. Okay. So watch out for that. And we'll have 2 inflation reports Wednesday and Thursday, CPI on Wednesday, I believe, PPI on Thursday, and I believe we have JOLTS data on Tuesday. So job openings data on Tuesday. So those are the last 3 pieces of data before we get to the showdown. So maybe we'll get a relief for 1 or 2 days from that, and then see ya, bye bye. I think we're just going to continue on our way down, because the second video you saw, like the whole thing about employment, we don't know what's going to happen with the employment numbers going forward. So there's a level of uncertainty. Markets do not like that. Okay, so I think that's it. I might have one more stock, so I might have to pull it back up. Let me see to talk about. Oh, yeah. I have 2 more, actually. Hold on. Before I leave this. Or 3 more, actually. So if you remember ASTS, man, it's so tempting, right? This thing is so tempting. It looks like it's ready to go. It ended the week pretty well. So it survived through all that noise. The charts maintained. So the question, like I told you guys like two streams ago, the question was, is it going to fail and end up like a Peloton? So Peloton was like one stock that I thought like might have a chance, but no, you see, it's just like it just failed. So now we just gone through everything. This is it. We're over. This is done. There's no way it's just going to break out and go up. Okay. The other one was a firm. So if ASTS is more like a firm, then it can be like here, where you have this move. I'll draw this again. So you have this little creek right here, and then you bounce up, and then you continue on your way up. All right, but at least now a firm, like at least it got to a new high. But look at a firm right now. Now it's gone back into this range between 52 and 66. No, not a good sign. It'll just recover for a little bit, for a little while. Maybe you go up to 64, 61, 60 again. But after that, it's just going to roll over. This is over. Yeah, this basically is the prelude for the final drop back down to who knows. Like maybe it'll just go back here to 23. If the market really just throws up. Okay, so stocks like this are very dangerous right now. They're very sensitive to how the market's running. So here you can see the red DI coming up. So for the weekly, this is a weekly chart. So yeah, that's it. So I don't know what ASTS will do, but I'm definitely watching that next week because I might add, just in case. You never know, it might just pop really strongly, because there could be a lot of shorts out here waiting to see a market drop, but it might not come in time. The market might drop in 2 weeks, but next week we might be able to have 2-3 days, and this thing could just rally off of that, and then you could just scalp it for a couple days. Okay, so AST, and you have to remember, we are at a all-time high pretty shortly. Once it gets above 38, once it gets above the 38, it'll be like Hims. Hims doesn't have any price history before like 35 or something like that. And after that, it just starts shooting up to 60 just because there was a lot of shorts in there. If there's a lot of shorts in there, yeah, that'll work out. Okay, so that's another thing to look at. And the last one, Fannie Mae, Freddie Mac. Okay, so these got hit pretty badly right now. Okay, so it's coming back, it's pulling back. This thing before New Year's was because Ackman came on CNBC and said he had a big position in this thing, and people here were just buying it because of the election. So it went from 126 to 296 or something, and back to 240, 220, and up to 6. Now it's going to pull back. So watch this one. So if you got like a nice IRA account and you need like a cheap penny stock to load up on, and you want to save this for the long term, yeah, just buy it because it's really cheap. So if you don't care about like, oh, I got in at $3 and then maybe I'll pull back to $2. Okay, so you lost 50%. Big whoop. I don't care about that. What you want to care about is like eventually this thing will recover and go all the way back up to where it was before the great financial crisis. So if you look at the history like of FMCC, like before the financial crisis, it was like 50 something dollars. So bro, if you can get it at $3, $2, $4, $5, and wait for it to go back up to $50 in 5-10 years, that's worth it. Okay, that's really worth it. The other one is FNMA. So Fannie Mae, same thing, similar thing. Okay, just different prices. So look at those two. FNMA, and FMCC. All right. Okay, dokie. That's good. Okay, so I'm gonna play some videos for you guys before I go. This is gonna be a short. This was gonna be a short one. All right. And make sure I got some memory freed. Shut down that stuff. And I'll play some videos. I'm not gonna play all the videos I put in the description. I'm just gonna play the ones that are important right now. I think are very important.
We got ourselves an interesting market. Hey, I got a lot of arrows on my screen right now that I'm going to talk about because every time that this arrow kind of shows up, it's actually at an interesting point in as far as gamma goes. So we're going to talk about that. Man, I'm recording this, and as soon as I hit the record button, I see Bitcoin drop like 7%. This market is just all over the place. So we're going to talk about it, map out some key levels, because there really is just one big thing going on tomorrow. I should say maybe two things. We have macro data, we have Fed Chair Powell speaking, and obviously we've getting hit left and right with these tape bombs. So we're going to map out some key levels, show you some of these signal charts, where they kind of line up, and kind of go from there. Let's get into today's show. All right, ladies and gentlemen, welcome back. Before I get into it, I forgot to mention, got to thank all my patrons and my partners, Interactive Brokers. I got some links in the pinned comment. That's all I'm going to say to that. We're going to start off looking at this chart. And this chart here is a chart of the S&P 500. And I got some levels drawn out on the screen. Ignore the white lines, right? The white lines were from today's price action. But I wanted to just call out that it's been basically one steady steep move to the downside. And right here is that gamma flip line that I put so much emphasis on as far as market.
Okay, if you remember, I talked about gamma before. Okay, Samantha LeDuc talked about gamma. And at certain points in the market, certain levels, there will be a place where it becomes positive and negative. And what that means is if you flip positively, right? So I think Samantha said if we got above some levels at 6150, where we could just like start shooting out, where it would just, the market makers would just keep buying stocks underlying, because the options market is driving it higher and higher. And then if you go the other way, you hit another level and you drop below it. So I think I'm going to play Samantha LeDuc's video after this, and she said it was like 5,800. Hans said it was 5,800. And so he said, if it drops around this level and goes below, then it's easy for the market to start crashing like quickly. So bouncing between that 5,800, okay, and that 6,150 area, I think that's why we've been stuck. You see, most of the time in late January into February, we've been stuck around that area, is trying to hold. But since last week, we went below it. And then this week, we definitely went below it hard. That's it. It's over. So it's just easier to go lower than it is to climb back up above it.
Conditions go every single time that I post a video, because it's that important to really understand. Well, how long have we been under the gamma flip line? Because it is changing. It is dynamic. Well, right now we've been there 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 trading days so far in negative gamma territory. And some of that, what I say when we're below the gamma, what we say is dealers will sell into selling, they'll buy into buying, which means volatility typically increases, liquidity dries up. But the best way to really highlight that is simply just looking at the times we're in negative gamma, which is the darker blue, right, underneath that zero line, and then highlighting it on the VIX. So you can see we got into negative gamma, we got out of negative gamma, we got in, we got out. And you can see when we go into it, it's a great insight to potentially seeing volatility really start to take off. We saw this big move over here into August. And then what do we got going on right now? Well, this day over here, when we started entering in 10 trading days ago into negative gamma, it happened intraday and the volatility took off, and it gave us some insight to saying, hey, this is where things could get a little crazy. So let's buckle up. That's one of the things that I look at as far as market conditions. The second is the direction of the 5-day moving average. We'll touch on that one in a little bit later. So why am I showing you these specific arrows? Because there's another way that you can kind of look into this. And what I did was here you can see that where we are as far as negative gamma goes, it's getting pretty frothy here to the downside. And if you just look back through history, the last times we were here was really August 5th, 6th, and 7th at this specific level. So I wanted to highlight, okay, well, we're also pretty low here and we're also pretty low here. So what does that look like on the chart? Well, here you go. August 5th, 6th, 7th actually happened to be after some serious sell side, and it found a market bottom. You saw this little low right over here, right? That was the one there shortly after, right over here. Okay, if we go back, you can see that this one right over here, it marked a low. It actually kind of bottomed out, and then we moved. And then over here, which was in December, this one right over here, you can see that we actually close a very, very strong move to the downside. This is, if you don't remember this day, this is the day that I was at the NASDAQ closing bell ceremony, which felt like we kind of kicked off the market mayhem over here. So there's a post on Twitter that when we on the day I said this is a market top. It wasn't the market top, but sure as hell started off this volatility. It was more of a joke than anything. But then we started to recover, right? And there shortly thereafter, we went a little bit lower, started to bounce, then we saw more volatility and so forth. Well, the reason why I'm just showing you now is because it is getting pretty frothy. And we're coming down into that inclining 200-day moving average. So this isn't to say that we can't go lower, but if we do go lower, where could we potentially go? Well, be mindful. An hour before the market opens up, we have some jobs data, and we have Fed Chair Powell speaking there a little shortly thereafter. So it's going to be important to pay attention to what we have as far as expected moves. And let me just go off by saying they're big. Okay, we'll talk about those in a moment. Let's go ahead and take a look at the S&P 500 from a weekly perspective. This is a very large range candle. The last time we actually saw a candle of this magnitude, it was right over here, right? So it was about the same length. But if you go back throughout history, I drew a little line on this and kind of went through it. And I was like, wow, we haven't seen one of these really since and around the 2022-ish bear market, where we started to see this width and this range of a weekly candle. So sometimes when you get these very, very strong moves, you can see snapbacks, right? We always talk about the rubber band effect, how, or just looking at markets move between expansion and contraction. When a rubber band expands, it'll typically contract. But also just be mindful that sometimes rubber bands snap, they break, right? And crashes do tend to happen from oversold conditions. Right? Risk happens kind of slowly, and then boom, it happens really quickly. If we take a zoom out of the weekly time frame for the S&P 500, the divergence that we've been tracking is playing out into that 40-week moving average. It doesn't look like anything, huh, when you like zoom out and you like look at the big picture, but it feels like something, right? So the MACD is still pointing basically straight down. Yeah, can we see bounces? Of course, but every bounce should be monitored very closely given the context of where we stand as far as market conditions go. Now, as this is coming in too, I wanted to bring up the Qs on the daily chart because we kind of slammed into a pretty interesting level here at around 485. And the reason why this is interesting to me is because when we approach these levels, we've seen some pretty explosive moves from it. So for example, we saw an explosive move to it and pushed away. Then we saw an explosive move break from it. Then we gapped overnight through that, and we saw an explosive move to the downside. Once we came back up to it, explosive move back to the downside. And then you can see even over here, it's acted as support, and we've seen some pretty explosive moves from it. And now we're pulling right back into it. Are we going to see some sort of an explosive move back up to around 500 on the Qs, potentially higher? And if we do start moving up higher, where can we potentially look for a dead cat bounce level? Well, you can pay attention to 510, and if it starts...
There you go. Okay, so I expect to move up from this level, right, on the QQQ. And then when we hit somewhere in the 500s, maybe even get to high as 520, prepare to short, because the next time we get back to 495, 485, watch out. It could just break apart and go a lot lower, and you'll get a big move, really big move that you can take a good chunk of profit from shorting at the right time. So for you guys shorting, that's what you got to watch for.
It's coming back down. That could be considered a dead cat bounce if it takes out these levels. Or we get a gap down risk, but we got to look now as we're coming into a key level that's held as a potential area of support. Where can we potentially see this market? So once again, I'll be talking about those expected moves. Now, as this is happening and as we're coming into some key levels in the market, we also are getting just continued
So if you want to see that continue that video, you can go to the description. You can check it out because yeah, he goes over some more charts. Now let's go on to Samantha's video here. I think she did a recent one. She just posted it today, so this one will be good. This one will be good to pay attention to.
Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Dollar is still very, very weak, very large dump, not since November of 2022 when they came in with massive central bank intervention. So wouldn't be surprised for a little bit of a bounce here. 104, maybe all the way up to 105. The government shutdown, we'll see what happens. But the point is money's moving home. So I wrote about that, and I wrote about it not just once, but actually twice. Once is just this week because of the fiscal stimulus that's starting. Japan, Germany, EU is committing. Now, I don't think it's going to work. I think, they're going to have sovereign debt issues in the next year or two. But for right now, foreign investment in the U.S. is not wanted. Trump, Bessent, Musk, right? They have the trifecta of lower dollar, lower yields, lower oil. They're pushing oil down for sure, but not too far, too fast. That'd be disruptive. But they are still talking $50. That's what Navarro said the other day. Bessent is very focused on bringing down treasury yields in support of the bond market. And that is going to be their playbook at every opportunity. And the dollar, of course, falling is not a surprise, but because they want less demand of dollars. They don't want to lose this exorbitant privilege, but they will slowly. And that's okay if the dollar comes down from a very overvalued place to help exporters of the U.S. in the future. But for right now, there is going to be some short-term pain as most likely the basis trade gets unwound. So money is going home. The basis trade is mostly levered hedge funds that hold on to this treasury short and push Mag 7 concentration risk. That is something that they very likely will start to unwind, and it will be helped by yen carry trade unwind part 2. And we're getting kind of close to that triggering. It's already triggered, but I mean really picking up speed. So in any case, I wrote about this dollar dump and some of the reasons that it's being helped, and just a reminder that there's 17% of U.S. equities are held by foreigners, and they're absolutely incentivized here to sell. So we got a no stay of execution there. The rate spread differentials, I focus on the U.S., Japan, but here's another one, really good one. 10-year interest rate differential with the euro versus Germany is also a very large spread. Anyway, long story short, I did a big piece on this before where I talked about the reason that we have been long stocks because it's basically short the dollar, relatively speaking, real versus nominal. And I go into that explanation. So this is a dig into real versus nominal value of the dollar. This is basically just flat out dollars going home as it relates to the stock market selling and taking your chips elsewhere because there are higher yields. There's also tariff risk. There's also, again, Trump, Bessent, Musk, very coordinated. They want the bond market protected. So stocks are coming under distribution. And it hasn't even picked up speed yet. Like this has been a very controlled selling. We have almost a mild recession is what they're gunning for. It feels very likely that we get that pulled forward because of the tariffs driving down demand, etc. So this is definitely money going home. Long story short. All right. So as dollar is falling, also surprising that gold hasn't fallen more. I mean, hasn't risen more, right, with that outsized move. But we have the kind of stochastic sideways, sideways, sideways. And we have every rip just creates a dip, every short the rip, and we just keep rolling over. So we haven't really seen fast selling, and that means we haven't seen a volatility spike. But there's nothing in my read that says volatility is done going up. Nothing. And again, this is on a 2-hour, but you can kind of see that we just keep getting repelled. And the only reason why oil is bouncing is because of the SPR news. So we've got to look at Japan now very seriously because Trump is out last night and he is talking about tariffs on Japan. Remember, they're kind of a hot potato as it relates to their housing of military bases for the U.S., but also friendly, a big, huge, important friendly as it relates to proximity to China. So bonds are getting bid again, and that's the safety safety. That's also recession risk pulled forward. Tariffs on Japan would cost the US a lot, but it would also trigger even more yen carry trade unwind, in my humble opinion. So I've written about that before, and I think it's time to revisit that and protect against that. So the yen carry trade unwind had already triggered. I mentioned that actually a few weeks ago, but it's the rate of change that determines the velocity of the equity selling. So this is why I study very, very closely, not just what the dollar's doing, but what oil is doing, because it impacts, and our rate differential with Japan impacts that fractal with SPY cues. Again, the basis trade is hedge funds shorting aggressively US Treasuries and buying aggressively the VIP stocks, primarily Mag 7. That unwind is what we had back in July. So we saw that forming, that yen was going to start rising, and then it started picking up speed. And then the 10-year yield in the US dropped precipitously, right down to that 3.6. So this is unwind that we had in equities on levered short treasury long Mag 7. It reversed. It's going to happen again. It's been very controlled. Puts are the most, in history, whatever. Well, that's because folks are really, really, really protecting. Anyway, this differential continues to fall. This is on a 2-hour, just to kind of show you. This is January 13th, where we're headed. That's my humble opinion. And nothing here has shown a little bump here, a little bump here, a little bump here, but it keeps ratcheting lower. So this is the rate spread differential US Japan, and that just means you hold on, you just keep holding on to those shorts. This is gold continuous. We haven't done any head and shoulder yet, but as you can see, dollar yen has definitely broken through, didn't even get up to 152. Like, that was the risk. It couldn't. It's basically following the market lower. And that's the risk that we have a yen trigger even more. Here's that volatility spread, and we are still not even at August lows or that big shake and bake of 3% down day with SPY. When we get a 3% down day, we'll trigger even more volatility. We're not there yet. Slow. It's really, 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 really slow. Look at the intraday volatility we have been having is up here, right? So very, very strong, just like the July carry trade. It's been very, very strong. And we
So I'm going to stop there. So going back to the VIX chart she just
volatility
did.
we have been having is up here, right? So volatility per day will trigger even more volatility.
So look at this. So this is the 3-month out volatility over the spot volatility, the front volatility. All right, that's a ratio she draws here with this chart. Now I'm going to show you. Go back to that previous guy's video, and he's going to explain it out a little more. So I mentioned this in the previous stream, so maybe this is a little bit too advanced for some, but keep this in mind, because maybe one day we'll talk about
Ourselves an interesting
Here, I'm going to go back all the way to the part where he's going to say this.
a prior level where we saw it bounce from before. So we'll see here if this turns into somewhat of a bullish divergence to give us a little bit more something to kind of
Okay, it's coming up. It's coming up.
sink our teeth into. Now, as this is also taking place, back month versus front month volatility is now down to under 0.96. Remember, when it gets out into these areas, the market tries to find itself some footing, get its head off the mat, stand up a little bit, and we haven't really seen that yet, albeit the last 3 trading days have been kind of sideways overall, with today obviously being down. And this is also occurring while VIX futures remain in backwardation, so it's just telling you, hey, we got problems here right now, and eventually we see volatility lower into the future. So remember, these curves are supposed to go this way, right? Where you say, yeah, everything's good now, but we're always going to plan for things that could potentially happen into the future, right? Risk always happens out there, but right now it's happening right now. Let's take a look at those expected moves. Here's a picture of the SPY.
Okay, maybe that was a bit too quick for you, but you can play that back. All right, I'm going to continue with Samantha's thing now.
Yet slow. It's really, 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 really slow. Look at the intraday volatility we have been having is up here, right? So very, very strong, just like the July carry trade. It's been very, very strong. And we are in negative gamma, and we have been in negative gamma, and we're going to stay in negative gamma until we get some relief here. And there's no headline relief at all. Hedge funds have been
So you look at those 2 lines, right? That green one, and then you got that red one. So that's why she was saying like 6150 was where you were going to have a big move up. If we got through that level 2 weeks ago, or even last week, even if we went down, it could come back up, but it didn't. And now we're at 5,800. If it gets further from 5,800, bad things will happen. So I'm not going to play the rest of Samantha's larger talk from this week today. I played a part of it last stream. I'll play it maybe tomorrow if I have time. I'll show up again and play part of it and then go forward and play the rest for those of you who are interested in the options side of things. But I'll continue playing this one. It's going to end shortly, so we'll be done in a full hour here.
Selling aggressively. Like, look, historically, this is really aggressively. Some reasons for it. I personally would just love to see it flush, but it has been very controlled. I have been assessing all kinds of VIX instruments, UVIX, tail risk, the 9-day, my ratio, VIX itself, SVXY, VVIX, every single instrument of volatility that I'm studying is still intonating higher. And NASDAQ has closed below the 200-day moving average. Usually, this means we're going to have nasty little 2-week chop in at least 2 weeks of chop around here, potential flush, but we haven't flushed yet. That's all. So we're waiting for a flush, and we got some reasons that might help us get there. We've got basically CTAs that have a whole bunch to sell. Basically, the stock buybacks that come in, they counter, which are automatic oftentimes, they counter with the CTAs that are also selling, and they're forecasting, for example, if we have negative 2.2, they sell 100 billion for the sale over the next week. If the leverage falls like it did, in other words, levels start going back to the August 2024, they'll have even more to sell, 200 billion total. If we were to go all the way back to the leverage seen in 2022 lows, we'd have, 350 billion. So a lot of this is that market structure of quants where they are price insensitive. That's something to keep in mind. And then Morris McElligott, the quant brain that I follow, is saying, hey, Trump administration may need an engineered recession to drive disinflation, right? That disinflation impulse that I called this a few weeks ago before we fell 10% in the Q so far. This seemed like it was kind of slow motion train wreck. It still is. We have not crashed. We have not flushed. VIX is still very strongly bid, which may help dampen the spikiness of it. But we get a yen carry trade rate of change. In other words, a speed in the unwind, everything will change. But right now, definitely already have a rate cut expected for March. FOMC meeting in 2 weeks, less than 19th. And maybe they do a double, right? Maybe they do a double like they did in September. Anyway, we definitely have dollar weakness. It's negative wealth effect. Money's going home. We have falling stocks and crypto, even the crypto reserve, even the SPR promise of investment. We still have weakness in the oil patch, in equities, and in the dollar. And yields today are also kind of coming back down a little bit. But for right now, I'm watching the yen carry trade as a really, really important level for discussion and for follow.
Okay, guys, almost in an hour. I'll see you guys tomorrow if I can, and prepare for the next week. So this might be the last week we could see a bounce, and then from then on, we're going down, down, down. Or if we're lucky, we could keep the bounce going, and then when Jerome Powell speaks, it just keeps going up, and for some reason, you'll get a fake out. Who knows? Anything could happen. So like I said at the start of the year, what did I say? This is not going to be a happy time for investors. It's just a great time for traders, though, because right now the S&P is right back where it was before the elections. So anyone that bought like around the time before Trump got elected, you're right back to where you were if you were just playing the SPY straight. Yeah. So like I said, terrible for just buy and hold. Okay. We'll see if we can get through this. It's going to be challenging. Maybe you guys will learn something as we continue. And if you want to donate to Portia J. All right. Please like and subscribe as well. Her Cash App is $PORSHAJAYE and PayPal PORSHA@jghb.info, which is also her email. And if you want to, you can also use the Streamlabs link to donate. I think I put that up there somewhere. Let's see. If I didn't, I'll put it up here. Streamlabs. If the bot Rix didn't already give it already, Yeah, right here. It's also in the descriptions. Yeah, you can get the Streamlabs. All right. Put it up here, and you can email me also. So streamlabs.com/theurbanlandlord, and you can email me at crack, C-R-A-C-K, at jghb.info. All right, guys. I'll see you. I'll see you around.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should. Feel like I should go.